Let me tell you something most men in the market learn too late. It isn't 10 rules that make a trader profitable. It isn't some secret indicator tucked away in a dusty corner of the internet. And it surely isn't the constant chatter of tips and rumors that keeps your account alive. No, sir, if you stay in this game long enough, and if you pay attention, you'll discover that one sound rule, followed faithfully, can do more for your profits than a dozen clever tricks. Now listen carefully. The market does not pay you for being busy. It does not reward effort the way a factory job does. The market pays you for being right, and more importantly, for sitting tight when you are right. Have you noticed how most traders do the opposite? They jump in quick, they jump out quicker, and then they wonder why their equity curve looks like a broken staircase. I learned this lesson the expensive way. In my early days, I thought activity meant progress. I thought if I watched every tick and traded every swing, the money would naturally follow. But the tape, the old ticker, taught me otherwise. The big money was never in the thinking. It was never in the constant buying and selling. The big money was in the waiting, and that brings us to the one rule. Cut your losses quickly and let your profits run. Simple words, dangerous words, because they sound easy, don't they? But tell me, when you're in a losing trade and the market starts creeping against you, do you really cut it fast? Or do you sit there, hoping, negotiating with the screen like it owes you mercy? Be honest with yourself. Most traders hold losers like their family heirlooms and dump winners like hot potatoes. It's backwards thinking. The market doesn't reward comfort, it rewards discipline. When the chart tells you you're wrong, your job is not to argue. Your job is to get out and preserve capital for the next opportunity. Capital is your ammunition. Without it, you're just a spectator. Now, let's talk about charts for a moment, because the chart, if read properly, is the trader's truth serum. Price leaves footprints, trends leave trails. The market rarely moves at random for long. If you train your eye, you begin to see structure, higher highs, higher lows, tight consolidations before expansion. These are not accidents, but here's where most fellows stumble. They see the pattern and then they sabotage the trade. Why? Because they haven't made peace with risk. You see, profitable trading is not about prediction. It's about positioning yourself so that when you're wrong, you lose small, and when you're right, you win big. That asymmetry is the entire business. Everything else, the indicators, the news, the opinions, is just decoration on the storefront. Ask yourself this when you enter a trade. Do you already know where you're wrong? Do you know the exact price level that tells you the market has invalidated your idea? If you don't, you're not trading. You're guessing with expensive consequences. A professional speculator defines risk before he defines reward. He studies the chart, finds the logical support or resistance, and places his line in the sand. If price crosses it, he's gone. No drama, no hesitation. Because the first loss is always the cheapest loss. Always. But the second half of the rule, letting profits run. Now that's where patience earns its keep. Because the market has a funny way of testing your nerves when you're finally right. A little pullback here, a sharp candle there. Suddenly your floating profit starts whispering fears into your ear. Take it now, it says. Don't let it disappear. Sound familiar? This is where the money mindset separates the amateurs from the operators. The amateur trades his P&L. The professional trades the chart. If the trend is intact, if structure is holding, he sits. Not because he enjoys the suspense, but because he understands a simple truth: one strong trend can pay for 10 small losses. That is wealth building in the trading world. Not constant winning, not perfect entries, but controlled losses paired with meaningful winners. Over time, and only over time, that math begins to work in your favor. Now, I'm not telling you this rule will make you rich overnight. Anyone who promises that is selling something other than trading wisdom. What I am telling you is this: if you truly respect risk, if you truly allow your winners the space to develop, your equity curve will begin to behave differently. Slowly at first, then noticeably, but only if you follow the rule every single time. Consistency is the quiet edge most traders ignore. The market is a place where human nature is on daily display: fear, greed, hope, impatience. The charts reflect it all, and the trader who learns to master his own reactions gains an advantage that no indicator can replicate. So the next time you're staring at a setup, the next time your finger hovers over the buy button, I want you to pause and ask yourself one simple question: where am I wrong? And will I accept it quickly if price proves me so? Because that single moment of honesty, that single act of discipline, is often the difference between the trader who survives and the trader who profits. And once you begin to see how this one rule shapes every decision you make in the market, you'll start to notice something interesting. Define your risk before you ever think about profit. That is not just a clever line. It is the foundation of intelligent speculation. Yet most traders do the exact opposite. They stare at the chart and immediately begin dreaming about how much they might make. 10%, 20%, maybe more. But tell me, what happens when the market moves against them? Where is the plan then? A trader who enters without defining risk is not trading. He is volunteering for uncertainty. The market is under no obligation to reward your opinion. Price does not care how confident you feel, how clean the setup looks, or how badly you want the trade to work. It will move where it wants, when it wants. The only thing you can control, the only thing, is how much you are willing to lose if you are wrong. Do you know that number before you click the button? Professional traders do. Every single time. When you study a chart properly, you begin to see logical points where your trade idea is no longer valid. Maybe it's below a support level. Maybe it's above a failed breakout. Maybe it's beyond the structure that attracted you to the trade in the first place. That level, not your feelings, is where your risk must lie. This is how the game is played by those who stay in it. Because here is the quiet truth: most beginners miss losses are not the enemy. Large, uncontrolled losses are the enemy. Small, planned losses are simply business expenses. They are the cost of participation in a probabilistic game. Have you noticed how the market often punishes hesitation? A trader watches price creep past his mental stop and tells himself, just a little more room. Then a little more. Then a little more. Before long, what should have been a minor scratch becomes a wound that takes weeks to recover from. That is not bad luck. That is undisciplined risk. When you define your risk in advance, something powerful happens to your decision-making. You stop trading with hope and start trading with clarity. You know exactly what the trade will cost you if it fails, and once that number is acceptable, truly acceptable, you can execute without emotional bargaining. This is where confidence actually comes from. Not from winning trades, but from controlled exposure. Think about the chart for a moment. Every clean setup, every proper breakout, pullback, or trend continuation offers two things: opportunity and invalidation. Most traders see only the opportunity. The seasoned operator looks first for the invalidation point. Why? Because that is where the real risk lies. If the setup fails, he is out. No debate. And here's something else worth understanding: when your risk is defined properly, patience becomes easier. You are no longer watching every tick with anxiety, because you already know the worst-case scenario. The trade either works within its structure, or it doesn't. There is great psychological freedom in that. Many traders chase the feeling of being right. The better traders focus on managing being wrong. It sounds simple, but the distinction changes everything. Because in this business, being wrong is not occasional, it is routine. Even the best operators take losses regularly. The difference is they survive them. Ask yourself honestly, when you place a trade, are you thinking first about the money you might make, or the money you are prepared to lose? Your answer to that question reveals more about your long-term prospects than any indicator ever will. The market respects the trader who respects risk. Not immediately, not dramatically, but steadily, over a series of well-managed trades, the account begins to reflect the discipline behind the decisions. One strong trend can outweigh many minor mistakes. That is a truth the market teaches slowly, and only to those willing to observe their own behavior. Most traders think success comes from being right most of the time. They chase high win rates, quick scalps, and frequent action. But the arithmetic of speculation tells a different story. You do not need to be right often. You need to be right big. Have you ever looked back at your trades and noticed something curious? A handful of small losses scattered across the month, and then one clean, sustained move that paid more than all of them combined. That is not an accident. That is the nature of trends. Markets move in bursts of expansion. They spend long periods going nowhere, shaking out the impatient, and then, when conditions align, they move with purpose. The trader who understands this does not try to squeeze profit out of every wiggle on the chart. He positions himself to participate when the real move begins. But here is where most fellows sabotage themselves. They take profits too soon. A trade finally begins to work, price break structure. Momentum builds. And just as the trend starts to stretch its legs, the trader grows uncomfortable. The open profit feels fragile. The fear of giving it back creeps in. So he exits early, satisfied with a small gain, and watches the market continue without him. Sound familiar? This habit is expensive, not in a single trade, but over a career, because the math of profitability depends on allowing your winners to be meaningfully larger than your losers. If your average loss is 1 unit and your average win is also 1 unit, the game becomes unforgiving. But if one well-managed trend produces 5, 8, or 10 units, suddenly the entire equation shifts in your favor. That is how professionals survive the inevitable mistakes. Now, this does not mean you sit blindly and hope every trade becomes a home run. Hope has no place in this business. The chart must continue to confirm your position. Structure must hold. The trend must remain intact. But as long as those conditions persist, your job is not to interfere unnecessarily. Can you sit still when you are right? It sounds easy in theory. In practice, it tests every impatient nerve a trader has. The market will shake, pull back, and hesitate just enough to make you question your position. Weak hands interpret normal pullbacks as danger. Strong hands recognize them as part of the trend's breathing process. The chart always tells the story, if you are calm enough to read it. Think about wealth building in trading terms. It is not built from constant perfection. It is built from asymmetry, controlled losses on the downside, open runway on the upside. One meaningful trend captured properly can pay for a long string of disciplined scratches. This is why position management matters as much as entry. Anyone can spot a breakout now and then. Fewer traders know how to stay with it. They micromanage. They overreact to noise. They let their profit and loss column dictate decisions instead of the actual price structure. And in doing so, they repeatedly harvest small gains while missing the very moves that could change their monthly results. The seasoned operator understands something the crowd often misses. The market does not distribute profits evenly. Most days offer very little. A few days offer a great deal. Your job is to remain solvent and prepared until those high opportunity moments arrive, and then have the discipline to stay with the move as long as it behaves properly. Ask yourself, when the next clean trend appears on your chart, will you treat it like just another quick trade, or will you give it the room required to become something meaningful? Because in the long run, it is rarely the number of trades that defines a profitable trader. Trade what the chart shows, not what you hope happens. That sounds obvious when you hear it spoken plainly. Yet the market is full of intelligent men doing the exact opposite every single day. They come to the chart not to observe, but to confirm what they already want to believe. And the market, being the great examiner that it is, has a habit of charging tuition for that mistake. Price is the final authority, not the news, not the rumor mill, not the confident voice on social media. The chart reflects the collective action of every participant with real money on the line. When price breaks support, it does not matter how strong the company sounds. When a trend forms higher highs and higher lows, it does not matter how many people insist the market is too high. The tape tells the truth to those willing to listen. But tell me, how often have you watched a clean bearish breakdown and thought, it'll bounce? How often have you seen a strong uptrend and told yourself, it's gone too far? That is hope talking. And hope, in trading, is an expensive companion. The disciplined trader approaches the chart like a detective, not a dreamer. He asks simple questions. Is the trend up, down, or sideways? Is price respecting key levels? Is momentum expanding or contracting? These observations form the trade, not personal opinion. Because the moment you begin arguing with price, you have already stepped onto thin ice. One of the most common habits among struggling traders is prediction addiction. They want to call tops. They want to call bottoms. They want the satisfaction of being early and impressive. But the market rarely pays extra for being first. It pays for being aligned with reality. Have you noticed how often clean trends continue longer than most people expect? That is because crowds tend to fight the chart instead of following it. They sell strength too early. They buy weakness too soon. And in doing so, they repeatedly place themselves on the wrong side of momentum. The experienced operator waits for confirmation. He lets the market reveal its hand. When price establishes structure, when it proves its direction, only then does he act. Not because he enjoys being late, but because he prefers probability over ego. Charts are not fortune-telling devices. They are behavior maps. Every breakout, every pullback, every consolidation is simply the market expressing supply and demand in real time. Your job is not to impose your story onto the chart. Your job is to read the story already being written. This requires a certain kind of humility. You must be willing to admit, quickly and without drama, when the market contradicts your idea. Many traders struggle here. They become emotionally attached to their analysis. They defend losing positions not because the chart supports them, but because their pride does. The market has little patience for pride. When price invalidates your setup, the correct response is not frustration, it is exit. Clean, mechanical, professional, because every moment spent hoping for recovery is capital exposed unnecessarily. On the other hand, when the chart confirms your position, when structure holds and momentum builds, your role is simply to stay aligned with what is actually happening, not what you fear might happen. This is the quiet discipline behind consistent trading. Ask yourself the next time you study a setup, are you seeing what is there or what you want to see? Because the trader who learns to separate observation from expectation begins to operate on a different level. He stops forcing trades. He stops anticipating moves that never materialize, and slowly, almost quietly, his decisions begin to reflect the one thing the market respects above all else: objective behavior. Your first loss is usually your cheapest. Take it quickly. That lesson has been written on more trading accounts than most people care to admit. Yet it remains one of the hardest habits for traders to truly accept. Not understand, accept, because understanding it with your head and obeying it with your money are two very different things. The market has a way of offering you an easy exit early in a bad trade. A small scratch, a manageable cut, a polite warning, if you will. But many traders ignore that early signal. They hesitate. They negotiate. They tell themselves the market just needs a little more room. Have you ever watched a small loss turn into a stubborn position you wished you had closed earlier? Of course you have. Every trader has paid that tuition at least once. The reason the first loss is the cheapest is simple arithmetic. When a trade moves against your defined level of invalidation, the original premise of the trade is already damaged. The longer you stay after that point, the more you are no longer trading a setup. You are defending a mistake. And mistakes grow expensive when given time. Professional operators treat the first exit signal with respect. Not fear, respect. Because they understand something the hopeful trader often ignores. The market is perfectly capable of moving much farther against you than seems reasonable in the moment. Price does not care where you entered. When your stop level is hit, whether it's below support, above resistance, or beyond structure, the correct action is immediate. Clean, mechanical, without emotional debate, because every tick you delay increases both financial risk and psychological pressure. And here's where discipline really shows itself. Most traders do not blow up because of one large gamble. They bleed out slowly from a series of small decisions to ignore risk. They move stops. They widen stops. They remove stops entirely, each time telling themselves the same dangerous story. It'll come back. Sometimes it does. And that is precisely what makes the habit so costly. Because the occasional recovery trains the mind to tolerate poor risk behavior, it builds a false confidence that the market will eventually cooperate. But markets have long memories, and sooner or later they deliver a move that does not come back in time. That is the trade that does the damage. When you train yourself to take the first loss quickly, something important happens to your overall performance. Your drawdowns become shallower. Your emotional state becomes steadier. Your capital remains intact long enough to participate in the next real opportunity. Capital preservation is not glamorous, but it is powerful. Think about your chart work. Every valid setup has a line in the sand, a price level that proves the idea wrong. That level is not a suggestion. It is the cost of doing business. When price crosses it, the trade has given you new information. Ignoring that information is not confidence. It is stubbornness dressed in trading clothes. Ask yourself honestly, when your stop gets hit, do you exit cleanly, or do you start explaining to yourself why this time might be different? The trader who survives long-term treats exits the way a surgeon treats precision. Quick, deliberate, and without hesitation. He knows another setup will come. He knows another trend will form. But he also knows that protecting capital today is what allows him to participate tomorrow. Because in this business, survival always comes before success. Let structure, not emotion, decide when you exit. Most traders believe their problem is entry. They spend hours hunting for the perfect signal, the perfect pattern, the perfect moment to get in. But if you watch closely, really watch, you'll notice something else. Many decent entries are ruined by poor exits. Not because the chart failed, but because emotion took the steering wheel. Have you ever closed a good trade early just because the profit started to fluctuate? That little knot in the stomach, that urge to lock something in, that is emotion speaking louder than structure. And the market is very good at provoking exactly that reaction. Structure is the trader's compass. It tells you whether the trend is intact or breaking down. Higher highs and higher lows in an uptrend. Lower highs and lower lows in a downtrend. Support holding. Resistance respecting. These are not opinions. They are observable facts on the chart. When structure holds, your job is patience. When structure breaks, your job is exit. Simple in theory, tested heavily in practice. Because the market rarely moves in straight lines, even the cleanest trend will pull back, pause, and shake just enough to make the undisciplined trader uncomfortable. Price will dip into prior ranges. Momentum will cool temporarily. And in those moments, emotion begins whispering, what if this is the top? But here is the professional's advantage. He does not ask what if, he asks what is. Is the trend still intact? Are key levels still holding? Has the market actually invalidated the trade, or is it simply breathing within normal structure? These questions keep the decision anchored in reality instead of fear. The amateur watches his profit column. The professional watches the chart. That distinction alone separates many consistent traders from the frustrated majority. Now, this does not mean you ignore warning signs. Structure speaks clearly when something changes. A failed breakout, a loss of key support, a shift in trend behavior. These are legitimate exit signals. But they must come from the chart, not from the discomfort of watching unrealized profit fluctuate. Do you trust your levels enough to let them do their job? Because once you define your exit based on structure, you remove a great deal of emotional noise from the process. You are no longer guessing moment to moment. You are following a plan that was decided when your mind was calm and objective. This is one of the quiet disciplines of wealth, building through trading. Many traders unknowingly cap their own upside because they exit based on feeling rather than evidence. They cut strong trends short and then spend the rest of the week trying to make up for the missed opportunity with additional trades. More trades mean more exposure, more commissions, more chances for mistakes, all because the original exit was emotional instead of structural. The market rewards the trader who can sit with controlled discomfort, not reckless holding, controlled, informed patience, the kind that comes from knowing exactly what must happen on the chart before the trade is no longer valid. When you begin operating this way, something shifts. Your trades become less reactive, Your decision-making becomes quieter. You stop flinching at every pullback and start evaluating whether the market has truly changed character. And over time, that simple habit, letting structure, not emotion, decide your exits, begins to show up where it matters most. Protecting capital is the trader's first real job. Not picking tops, not catching bottoms, not finding the next hot setup. Those things may look impressive from the outside, but they are not what keeps a trader in business. Survival does, and survival in the market comes down to one thing above all else: keeping your capital intact. Because without capital, opportunity means nothing. The market opens every day. New setups form every week. Trends come and go whether you are ready or not. But if your account is damaged beyond repair, you don't get to participate. You become a spectator in a game you once played. Have you ever noticed how the traders who last the longest are not always the most brilliant? Often they are simply the most careful. They understand that trading is not a sprint of big wins. It is a long campaign of controlled exposure. Every position you take is a business decision. Every dollar risked is inventory placed on the table. And like any good operator, your first concern is not how much you might make. It is how much you can afford to lose without harming the enterprise. This is where many eager traders get it backwards. They think in terms of profit targets before they think in terms of position size. They load too heavily into a single idea. They risk too much of their account on one trade, and when the market does what it always does, moves unpredictably, the damage is done quickly. The market punishes overconfidence with remarkable efficiency. Professional traders approach risk like engineers, not gamblers. They calculate position size based on account equity. They define maximum loss per trade. They understand that no single position should have the power to meaningfully injure the account. Do you know what percentage of your capital you are risking on your next trade? If the answer is vague, the risk is already too high. Protecting capital also means knowing when not to trade. That is a point many overlook. There are long stretches where the market offers poor conditions. Choppy ranges, low momentum, unclear structure. During these periods, the disciplined trader reduces exposure or stands aside entirely. Why? Because unnecessary trades are silent account killers. Every trade carries friction, spreads, slippage, commissions, and the simple probability of being wrong. When conditions are not favorable, preserving capital by doing nothing is often the most profitable decision available. Patience, once again, shows its value. Another part of capital protection is emotional control. Large swings in account equity create large swings in decision-making quality. When traders take oversized losses, they often follow them with revenge trades, impulsive entries, and poor judgment. One mistake begins to multiply into several. But when risk is kept small and controlled, the mind stays clear. Think of capital as your trading lifeblood. Your charts, your strategies, your experience. None of it matters if the account cannot withstand normal market movement. The goal is not to avoid losses entirely. That is impossible. The goal is to ensure that losses remain manageable, predictable, and recoverable. Ask yourself this: if your next 5 trades are losers, and that can happen to anyone, will your account still be healthy enough to continue? The trader who can answer yes to that question is playing a very different game from the one who cannot. Because in the end, the market does not reward the boldest participant. It tends to reward the one who manages risk well enough to stay in the chair while others are forced out. Consistency in following one rule beats mastering many indicators. That statement rubs against the instincts of most traders. The modern market is full of tools, signals, oscillators, colored lines stacked on top of other colored lines. It gives the comforting illusion that more information must lead to better decisions. But the tape, and the experience of every seasoned operator, tells a quieter story. Complexity often hides inconsistency. Many traders spend years jumping from one indicator to the next, always searching for the missing piece. When one system fails to deliver perfection, and they all do, they abandon it and reach for another. More settings, more confirmations, more noise. But tell me, what good is a brilliant tool if it is applied differently every week? The market does not reward scattered behavior. A trader who follows one sound rule with discipline develops something far more valuable than a clever setup. He develops statistical edge through repetition. Because in trading, outcomes mean very little in isolation. One trade proves nothing. 10 trades only hint. But over a large series of consistently managed trades, patterns begin to emerge. That is where real confidence is built. When you rely on too many indicators, you create decision paralysis. One tool says buy. Another says wait. A third says the market is overextended. Before long, the trader is no longer executing, he is hesitating. And hesitation, in a fast-moving market, is often as costly as being wrong. Have you ever missed a clean move because you were waiting for one more confirmation? Most have. The disciplined operator simplifies.